So what exactly is a share? Technically, it's a unit of ownership in a company. When you buy one, it's a bit like buying a small piece of that company. They're usually sold to raise money, and each share represents an equal portion of the company's total capital. People often take a long-term view when investing in shares, as they can go up or down in value, and the price is influenced by things like the performance of the company, what the economy is up to, and what the market thinks they're worth through being traded. An IPO is the first time a company offers its shares to the public. IPO stands for Initial Public Offering. This is when a company begins offering its shares to the public, usually in a bid to raise money. If you invest during an IPO, you won't need to pay any brokerage fees. Once the company is listed, the share price can rise or fall and is set by a number of things, including what people think the shares are worth. This price is regularly updated through the stock exchange. The investment statement or prospectus are the offer documents that tell you about the details of the offer and the company you are looking to invest in. It includes company information, the share offer itself, and some of the material risks and potential returns, if any. Remember, it's important to read the offer documents carefully before investing. When you buy a share, you'll receive holding statements from the share registry with a record of any companies you own shares in. You may also receive some information from the company itself, such as reports, dividend statements, and even voting forms. Once you own shares, you can sell them via a broker like ASB Securities at any time. Or you can transfer them off-market if you want to gift them to a family member or friend. You may also receive dividends on your shares. An advantage of some shares is that they can offer an income from dividends. A dividend is a payment that a company may make to shareholders. Often it's a share of profits, but dividends can be paid for all sorts of reasons. Some companies pay reliable dividends every year, others don't. So if you're hoping for an income from investing in shares, this is something you should look into closely. A stock exchange is the market for all publicly available shares. It keeps a record of share values and how they change over time. Stock exchanges also record how many shares in any particular company have been traded at any one time. The New Zealand Stock Exchange is called the NZX, and the Australian Stock Exchange is known as the ASX. A stockbroker is someone who is licensed to buy and sell shares on the stock exchange. If you want to buy or sell any shares on the stock exchange, you'll need to use a broker. Most brokers charge a brokerage fee, often a percentage of the total value of shares you are buying or selling. So if you're thinking about investing in shares, it's important to include brokerage fees in your sums. But remember, there is no brokerage fee to buy shares during an IPO, only when you come to sell them.